AI is eating everything, and it might eat itself. That's Ray Dalio, looking at the AI boom and basically asking a rude question, which is whether the profits ever show up. He said it on the All In podcast, but the real punchline is how AI ties into the bigger machine Dalio obsesses over: debt, politics, geopolitics, and money itself. Welcome to X-Pulse Digest. The good stuff here is his super concrete read on America's balance sheet and why gold is acting like a smoke alarm. Dalio frames the US like a business with one special power. It can print money. Mechanically, he says, the government is projected to spend about $7 trillion and take in about $5 trillion. So you're running a deficit that's roughly 40% of spending. Then the part that makes it feel less like politics and more like basic finance. He describes the debt cycle like the body's circulatory system. Credit is healthy when it funds productivity that throws off income to service the debt. It's unhealthy when debt service grows faster than income, like plaque that slowly squeezes out spending. Right now, he points to a roughly $2 trillion deficit and says about half of that is interest payments. On top of that, there's about $9 trillion of debt that has to be rolled over because it's maturing. So you're not just borrowing for new stuff, you're refinancing the old stack at scale. And his handy number stays the same. 3% of GDP, deficit to GDP, is what he says would roughly stabilize the situation. The CBO estimate mentioned in the conversation for 2026 is about 6%. That gap matters because when the market starts caring, it cares fast. The next tension is simple. Supply is exploding, but demand has to be there, consistently, year after year. Dalio breaks buyers into domestic and foreign, with about a third being foreign buyers, and he argues it's getting riskier from their point of view. Not just because it's a lot of debt to absorb, but because their portfolios already have a lot of dollar-denominated debt in them. Then he goes to the geopolitical angle, which is the kind of thing you don't see in a spreadsheet until it's too late. If the debtor and creditor end up in conflict, the creditor starts imagining scenarios like sanctions or disrupted payments. He says you can imagine that with China, and even with Europe, where Europeans could wonder whether they will get sanctioned. This is where his history brain kicks in. These dynamics, he says, have happened repeatedly, and he points to the 1929 to 45 period as an example of the kind of environment where finance problems compound with political and geopolitical ones. So when you hear, "We'll just issue more," his point is, sure, but to whom, at what price, and under what political assumptions? The hosts bring up DOGE, the Department of Government Efficiency, and ask if it failed because of bad execution or because it's structurally impossible this late in the cycle. Dalio doesn't romanticize it. Trying to take an inefficient government and make it efficient quickly, inside an election calendar, in a society where every cut gets attacked from every angle, is, in his words, a hell of a trick to pull off. He's basically describing an operating constraint, not a policy preference. If you move too slowly, the math keeps getting worse. If you move too fast, you cut something visible and politically sensitive, and the mandate collapses. Then there's the uncomfortable reality check about management. Is it a surprise there's waste and inefficiency all over the place? He tosses out the Department of Motor Vehicles as a shorthand for big, complex, messy. Not exactly a shocking metaphor, but it lands because it's true in your bones. And that sets up the next question people are really asking, which isn't, is there waste? It's, what do you do when trust in the money starts wobbling? One of the hosts notes that last time they spoke, Dalio owned gold, and since then gold climbed from about $2,900 an ounce to $5,200 an ounce. Why? Dalio's answer is that people misunderstand what gold is. It's not just a precious metal people speculate on. He calls it the most established money, and says it's the second largest reserve currency that central banks hold. In his framing, this move is central banks building up gold, and individuals looking for alternative money. Then he delivers a deceptively spicy definition. Money, mechanistically, is debt. If you're holding money in the normal modern way, you're holding a debt instrument, which is a promise from someone else to deliver you buying power. Gold is different because it's not dependent on somebody's promise. It can be transferred, and they can't print a lot of it. He also separates wealth from money in a way that clarifies a lot of confusion. Wealth is stuff, buildings, companies, but you can't spend wealth directly. To spend, you sell it and receive money. Now add his warning. We have an awful lot of wealth relative to money, and when everyone tries to convert wealth into money at once, the temptation for authorities is to print, because that's what they've always done with fiat currencies. He even gives a practical portfolio guideline, with caveats. If you had no view on gold at all, he says one should have between 5 and 15% of their portfolio in gold, because it diversifies, especially when, as he puts it, the hit's the fan. Here's a sharp contrast from the conversation. In that same period where gold rose about 80%, Bitcoin was down about 25%. Why didn't it play the safe haven role? Dalio points to a few differentiators. One is privacy, he says. Bitcoin transactions can be monitored and, indirectly, perhaps controlled. Another is adoption at the institutional level. Central banks, in his view, are not going to want to buy Bitcoin and hold it. There's also a cluster of market structure reasons. He mentions questions around new technologies like quantum computing as a potential issue people think about. And he emphasizes who owns Bitcoin and why they buy and sell. If holders are squeezed elsewhere, they sell what they can. And he says Bitcoin tends to have a pretty high correlation with tech stocks. Then he zooms out and makes it brutally simple. It's a relatively small market compared to gold, and, in his phrasing, there is only one gold. Silver comes up too, and he treats it differently. He says silver supply is hard to increase because its production is residual. It has monetary history, but it's also taken on a speculative life of its own, with people hot in it because it's been hot. So the message isn't crypto bad, it's that in a real monetary scramble, the buyer base matters, and central banks aren't shopping the way retail is. The interest rate section is where Dalio sounds like he's walking a tightrope with a calculator. He calls out 3 main levers: taxes, spending, and interest rates on the debt. But you can't just force rates low, because one man's debts are another man's assets. If you push rates too low for the creditor, he says you produce the dynamic everyone understands: more borrowing, more money poured into things, fueling bubbles. Push rates too high, and the debtor gets squeezed. So policy becomes a balancing act, high enough to be adequate for the creditor, not so high the debtor breaks. He says that balancing act gets extra nasty because of what he calls the K economy. There's a part of the economy chasing bubble-like upside. Who will be the first to be a trillionaire? While another huge part is struggling. He drops a stat that's hard to forget. 60% of Americans, he says, have below a 6th grade reading level. And making them productive, especially as AI replaces some kinds of work, is particularly difficult. And that's why one-size-fits-all monetary policy is strained. A single interest rate for an economy with wildly different conditions can feel like using one thermostat to control a mansion and a garage at the same time. He's also asked whether the Fed will have to expand its balance sheet again if global central banks stop buying treasuries and shift to gold. His answer is cautious, but he says it's likely down the road. In the near term, he mentions shortening maturities, which helps manage borrowing costs but increases rollover risk, plus using persuasion on other countries to buy or hold debt, or to have other capital enter the US. Tariffs get discussed in a way that's more nuanced than the usual cable news shouting. Dalio thinks economists get something basic wrong. Many don't include taxes in inflation. His point is plain. If your taxes go up, that's inflation, because it takes money out of your pocket, not meaningfully different from housing costs going up. He also reminds you tariffs used to be the biggest source of government revenue through much of history, in many countries. So he treats tariffs as a valid way of raising money, and notes you can get foreigners paying a portion of it. But he's not selling a simplistic tariffs solve everything story. He says it won't come close to replacing income tax because of size and the impact of that size. And he calls tariffs regressive. The deeper argument is about unsustainable trade deficits. He says the U.S. has large trade deficits, which are capital surpluses on the other side, meaning dependence on foreign capital. In his view, that's not sustainable. So tariffs, to him, only make sense as part of a bigger plan to build the industries the country needs, economically and geopolitically. He paints a world that's moved from a multilateral order to a more confrontational, power-based economy, where goods and capital wars and threats to cut off supply chains are real. Independence becomes a strategy, not a slogan. But he keeps circling back to that 3% target and mentions bipartisan interest in a three-part solution involving some mix of taxes, spending, and, hopefully, interest rates. This is the part where Dalio stops sounding like a market guy for a minute and starts sounding like a historian watching a familiar movie. He lays out what he calls 5 big forces shaping everything: the debt and money cycle, domestic wealth and values gaps, international great power conflict, technology, and acts of nature like droughts, floods, and pandemics. Orders change, he says. Monetary orders break down for the same reasons. Political orders shift. International orders shift. Then comes his blunt diagnosis of the present. He says we're at a stage where there are irreconcilable differences, and when people care more about their causes than the system is in jeopardy. It predicts a future where nobody can succeed because everyone's fighting, pointing to the midterm elections as a potential flashpoint, and describing a kind of mob disorder and inefficiency where nobody's allowed to take charge. He even references Plato writing about cycles of democracies and brings up Julius Caesar and Rome as an example of where political violence and institutional breakdown can lead. And the prescription he gravitates toward is uncomfortable in a democracy. The country needs a strong leader, he says, someone tough enough to force difficult reforms, stop the fighting, and focus the country on productivity. It's not ideological in his telling. He calls himself like a mechanic, not trying to pick a team, just describing what the machine looks like when it's rattling. That mood sets up why he's so wary of bubbles in a moment when the country is already stressed. Dalio's most useful point about AI isn't, AI will change the world. Everyone already knows that. It's that, in technology bubbles, people think they're betting on the technology when they buy the stocks. He says that's not true. The technology can absolutely win and still destroy a lot of companies on the way there. A small percentage survive. The rest fight, dilute, disappoint, or die. Then he adds a twist that makes the current cycle feel different. The U.S. is primarily profit-based. China, he suggests, may treat profits as a second consideration. They might decide AI should be like electricity, make it free, open source, maximize usage, and get productivity gains through adoption. Now put those two systems in one world. If their technology is almost as good as ours, and you can get it free while US companies have to pay it back, then AI really can eat everything. And it might eat itself, at least in the stock market sense. If you want the full conversation, find Ray Dalio on the All In podcast. The lingering question he leaves you with is the same one he asks about money. What are you holding that isn't just someone else's promise when the cycle turns?